In this video, I'm going to talk about methods of stock valuation. There are four methods that I'm going to discuss. The objective of these methods is to put a value to the stock. When you calculate profit during the year, at the end of the year, you need to work out the cost of the goods which are sold during the year. And as we know, the stock can be bought during the year multiple times at different prices. So at the end of the year, which stock has been sold, which stock is unsold, what is the total cost of the goods which have been sold, and what is the cost of the goods which are unsold? How do we figure all that out? To answer these questions, we look at these techniques, these methods of valuing the stock at the end of the year. And we are going to do that with the help of an example. So the problem that we are trying to solve is that stock can be sourced. For example, if you are in, let's say, mobile retailing, you buy a stock of 10 mobiles, 5 are sold. You buy another 50, 20 are sold. You buy another 10, then another, some units are sold. So at a given point in time, there is so much confusion as to which stock is remaining. Maybe the first stock of mobile phones that you bought, they cost you 10,000 a piece, and later on 9,500 per piece, and the third lot that you bought costed you 10,500. So which ones are you selling? Because when the customer comes in, he looks at all the available models with you and picks one, which could be from any of the three batches that you bought from. So you have to keep a track of how at what point in time did you buy the stock, at what price, and then which units were sold. So we have to answer the questions that we mentioned earlier. So the problem is that similar stock can be bought at different points in time and sold as well. And at the end of a given period, which is a counting period for us, the value of the stock which is sold or unsold, that value has to be determined for us to be able to effectively manage the stock in the business and put a value to the cost of goods sold so that we can arrive at the profit for the year. Let's look at this example practice problem here. Here you are doing three different purchases on April 1st, 2020, on July 1st, 2020, and on December 1st, 2020. Three purchases are being done, 100 units at each purchase, but the price of the purchase is varying at each occasion. And then there are three occasions in the next year, although same financial year. Let's say this is 2020-21 financial year. And then the inventory is being sold, different units, and we have to figure out at the end of the year which of the units are remaining, which of the three lots, what is the value of the cost of the goods which have been sold, or goods that are unsold, what is the value. And the first method that we are going to use to value the stock at the end of the period is called LIFO method. This is last in first out method. This will become more clear as we attempt to solve this problem here. So we use this format, and again there are different formats, different methods, different approaches to this method, but the principle is going to remain the same. So there is one common date column, and then there is section 1 on purchase, second on sale, and third for the balance. The second section says issued or sold because it is possible if you are a retailer you could say sales, but in large manufacturing houses there is a stock department which maintains this record of different kinds of stock purchased and then issued to, let's say, workshop section, the section where things are actually manufactured. So they can use the issued heading in this column as well. However, let's stick to sales for ease of for easy understanding. All right. So the first purchase was done on April 1st, 2020. So let's put a year here, 2020, and we're going to say April 1. So on April 1, purchased 100 units, 10 per unit. So in the units column, I'm going to write 100, 10 per unit. So that gives me a total amount of 1000. So this is the first entry here. This is simple record, no specific format or no regulatory guideline of any sort to maintain this, but just trying to explain you one method of valuation of stock. At the end of this transaction, the balance remaining is 100 units at the rate 10 per unit, and 1000 is the total value of the stock with you. All right, first entry completed. Second is July 1st, 2020. So I'm going to write July 1st, 2020. Another 100 units are bought at this point in time at a higher price. Typical behavior of prices over a period of time, inflation goes up. So total amount of 1500 is spent on this purchase. Now notice that your stock is now 200 units. At the end of this transaction, you have 100 units at 10,000 rupees from the previous purchase. You also have 100 units at 1500 from the current purchase. This is the new stock level. So you have 2500 rupees worth of stock, 200 units of stock, and this stock is bought at 10 rupee at first and then 15 rupee at the second occasion. Okay, now we are maintaining separate records for these separate purchases. The third transaction is when we purchase stock again another 100 units, but this time 20 per unit on December 1st. So I'll write here December 1st, another 100 units, 20, so 2000 more, and now I have 100 units worth of 3 stocks, and each time the price has been going up, so different prices, and this is 1000, 1500 and 2000. So this is my total stock available. So at on any given day, if the stock register is checked, if anybody asks as to what is the value of the stock today, day end, you could just refer to this register and say this is the amount, and these are different prices. Okay, now let's get into more complicated business. Now the sales takes place, let's say January 1st, 2021. So we enter 2021 on January 1st. 100 units are sold. So 100 units have been sold. So no entry here, just like there was no entry in the sales column all this while, just to be clear. Okay. So 100 units are being sold, they are going out. The question is, what is the rate? And we do not want to write the selling price here. Selling price will go to the profit and loss account. This is internal accounting. This is internal to the business, stock accounting. We have 3 stocks of, three, what do you call it, consignments of stock with us, 300 units blocks. Which of these 100 is being sold is the question. Now this is where the FIFO method comes in. FIFO method is first in, first out. This means whichever stock you bought first in chronological order, that stock is assumed to be sold first. All right. Using that, we would say this is the stock which was bought, at the very first occasion, and this cost us 10 per unit. So therefore, we're going to use 10 here, and we will say 1000 rupees worth of stock has been sold. The stock may have been sold at 25 rupees, 50 rupees per unit. Doesn't matter. We're not considering that. We're only considering the cost price, so that we can say that at the end of January 1st, the stock which is remaining in the business is 200 units only, and this stock is priced at 15 and 20 each. Therefore, the total value of this stock is 3500, and 1000 rupees worth of stock has already been sold. This is the first in, first out method. Let's look at the next transaction, which is on Feb 1st, 50 units being sold. So Feb 1st, another 50 units being sold. Now, which of these 2 units is being sold? Well, the ones which came in first. So we are going to assume these units are sold and the price is 15. So 750 rupees worth of goods have been sold, boards in this case, wooden board, because we are dealing with a specific hardware store here. So these are sold, and now we are left with 50 units here and 100 units here, 15 rupees and 20 units, 750 and 2000. So this is the situation at the end of this transaction on February 1st. Let's look at the final transaction, March 1st, 20 units sold. So March 1st, again no purchases, 20 units. Now at what price? You still have 50 units of the previous board, so you are going to sell 20 units at 15 rupees, so this is 300. You are left with 30 units and 100 units at 15 and 20, so this is 450 and this is 2000. So at the end of the financial year, the cost of the unsold stock is equal to 2450. This is the cost of unsold stock, and you could very well calculate the cost of goods which is sold during the year as well, which comes out to be 2050. So this cost is shown in the profit and loss account, or the closing stock, which is shown in the final accounts, which helps you calculate the profit for the year. So this is first in, first out method. We could now go to the second approach, which is last in, first out. Pretty opposite of the previous case. So let's attempt the second approach as well. And in this approach, the first three transactions are going to be the same, which is the purchase transaction. So just like we had April 1st, July 1st and December 1st, three transactions of purchase, they are going to stay the same. So I'm just going to duplicate them here, and now I'm going to use the other transactions, which were the sale transactions. Let's see how that is going to affect the stock accounting here. So on January 1st and then Feb 1st and March 1st, there are three transactions, and we had 100 units being sold, 50 and then 20. So the question here is, what price are you going to use to record these sales at? Now in case of first in, first out, for this 100 which was sold on January 1st in 2021, we used first in, first out. So we used this 100, so 10 rupee. Now we are going to do the opposite. Chronologically, we are going to use the descending order, and we are going to use last in and first out approach. The last stock which was in is going to go out first. That is what it means. Therefore, at 20 rupees and 2000. And after this transaction, you are left with 100 and 100 at 10 and 15, 1000 and 1500. That's it. You have sold this last consignment of stocks. So on February 1st, likewise, you are selling 50 units, and you are going to sell the latest one first at 15 rupees, and this is 750. You are left with 100 and 50 at 10 and 15, so 1000 and 750. This is the amount of stock remaining with you. This is last in and first out method. Finally, on March 1st, you are selling 20 units again at 15 rupees, the latest stock that is with you. So 300, you're left with 100 and 30 at 10 and 15. This is 1000 and this is 450. So the unsold stock at the end of the year is 1450, and the cost of goods sold during the year come out to be 30 and 50. 27, that's right, 3050. So you see that there is a difference between the cost of goods sold according to the first in, first out method, which was 2050, and in last in, first out method, in this case the cost of goods sold is 3050. So these fluctuations in prices of the stock lead to this confusion, and therefore we have to maintain a stock accounting we have to do internally for the purpose of valuing the stock. Now let's look at another method which is called average cost method. Again, the top three entries are going to be the same. Only difference is going to be in the entries on December 1st, sorry, January 1st and Feb 1st and March 1st. And in this case, again, we have 100 units being sold, 50 and 20. The only confusion is, the only question to be answered is, at what price do we record these sales? In the first in first out we used this 10. In the last in first out we used 20. In the average cost method we are just going to use the average of these three. That's it. So average of these three comes out to be what? 15, 35, 45, 3. Yeah. So 15 is the average, and we are going to sell the stock. We are going to record the outward going stock at 15. Therefore, you have 1500 rupees worth of stock which is going out. Now, how do we write the balance? Now, from this point onwards, you do not write, separate balances. You are going to club everything up. So out of 300, 100 is, has gone out. So 200 is remaining at 15. So value of the stock now is 3000. And from here on, things become simpler. Yeah, the things become simpler because now you will always issue this stock at 15 rupees. So you're left with 150 units at 15. So 2250. This is the stock with you, and then again 15. You sell 300. You're left with 130 units of stock. Yeah, I think that's about right. And you're left with 1800 rupees worth of stock. I hope the numbers are right. 2250 minus 300. No, that's not right. So this should be 300. So 9. Yeah, 50. Let me write it here. So 51950. This is the amount of stock left at the end of the period. So here the cost of goods sold for you, here this is the number. So this is how much? 1950 and 2250 if there is no arithmetic mistake, but the approach is what matters here, not the essentially the numbers right now. And oh, not this, the amount of closing stock. So this is the closing stock and this is the cost of goods sold that you have during the year. Again, there is a difference in the cost of goods sold, 2250 compared to 3050 in case of last in first out, and 2050 in case of first in first out. This is the third approach. Let's look at the final approach, fourth approach, which is the weighted average cost method. Again, everything remains the same. All we have to do is calculate the price in a different way. So January 1st, February 1st and March 1st, you have 100 units, 50 units and 20 units. Now the price at which you are going to record the sale is going to be the weighted average, and the weighted average is sum of this divided by sum of this. That's all. So sum of this comes out to be 2500, 4500. So 4500 divided by 300. So this comes out to be 15. So essentially this comes out to be same as the average cost. The weighted average is also equal because we had 100 units each. Therefore my job becomes simpler here. Although I could have taken different number of units, in which case the amount, the numbers could have worked out to be different. But essentially, it gives you the same numbers. So you are going to have 2250 as the cost of goods sold, like you had in the previous case, in case of average cost method. So these were, four methods of valuation of the stock. The problem of valuation of the stock is important because at the end of the year, if you remember the final accounts from previous units, you have sales and you have closing stock, and you have to compare that to the cost. You have to figure out the cost of goods sold basically, and you have purchase here. So if I remember correctly, there was a question at some point in time, how do we figure out the value of the closing stock? And now we've answered that question at the end of the course, although regardless. So closing stock, in order to figure out how many units are left, what is the value, you use one of these four methods depending upon what is the management policy. There is of course an accounting standard as well which talks about valuation of stock, but again too technical, we're not going there. The idea is to only give you an overview in this course, and there are of course more detailed courses that can be taken in understanding the inventory management, which includes inventory valuation, inventory control, and some other methods of working with inventory. But for this course, this is where we stop vis-a-vis inventory management.